Hi, everyone. Thank you for joining us this afternoon. It's very good to see some familiar faces, names. And if you're new to the Tax Club, welcome. And I hope that you will enjoy today's session. As usual, if you have any questions, please put them down to the Q&A box below, and our speakers will reply to them later. So without further ado, I will hand over to Alan to start the session.
Thank you. Thank you, Ella. Hi there, everybody. A decent turnout again. My daughter said to me last night, Dad, how do you know that they bother listening and maybe they've gone off and done something else? And I said, people who come to my tax club don't do things like that. So what I've done, I've introduced some secret spyware that if you do wander off, I know who you are. And if you believe that, you believe anything, because I know nothing about technology. So without further ado, today, I've got my trusted VAT man who has the best surname in the world, Rob McCann, speaking. And as I always say on these occasions, and he gets sick of hearing it, we're not related, so that's good news for him. So I've also got Andrew Gregory. Now, Andrew Gregory and I probably have known each other certainly since the early 90s, I would suggest. We never did a lot of work back then, but I can tell you that your wife did my will.
Good. Right. Well, let's hope she got it right then, Alan.
No idea. Never read it. I trusted her implicitly. Andrew's going to speak on shareholder agreements, and it's an important issue. And without shareholder agreements, many businesses suffer when there is a fallout or there's a sale or whatever else. So please pin your ears back when Andrew speaks. One thing someone asked me the other day, Andrew, just as out of curiosity, they said they couldn't make it, but they would like to hear what you've said. Would there be any issues if Ella could arrange it that your section was made available to other people? Or
yeah, I'm happy with that, Alan. Yeah, no, there's no trade secrets here. It's all good stuff. So yeah, no problems.
I'll have a word with Ella about the logistics of that later. Right, without further ado then. What's been going on? As I say, I've actually done a list of things I want to talk about today. I want to start off with some case law that's filtered through, which is always good. I always pick out the ones where I would hope all of you see some relevance. And the first one is a case of a chap by the name of Mr. Hampel, Hampel. And this was a situation where penalties were charged on him for failing to submit personal tax return late submission penalties. And the answer at the end of the day was that it was determined that the penalties were disproportionate. And it's worth just bearing this one in mind. So I'm going to read sort of the overview of it so that you get a flavour. The taxpayer set up his business in 2012, and he usually engaged an accountant to file his company and personal tax returns. But when the business started to decline, he completed his personal tax returns himself. He submitted the returns for 15-16 and 16-17 late, and as you would expect, HMRC imposed penalties. Mr. Hempel appealed against the penalties. The first tier tribunal found first that HMRC had served the late filing penalties correctly. So that's good news for the revenue. However, the tribunal was not satisfied that the department issued a daily penalty warning letters. It produced no evidence to show the date the letters would have been sent. Therefore, the taxpayer's appeal against the daily penalties was allowed. Now, too often, it's easy to say that I didn't get the penalty notices, but equally, we're finding more and more, certainly back in the day in this period now is what, 5 years ago, 4 years ago, that the revenue struggled to produce evidence that the letters had actually been sent out. So if the client or the taxpayer is convincing at the tribunal, it's quite often the case that the tribunal judges will go with them if they believe they're credible. The next question was whether the taxpayer had a reasonable excuse for the late filing of his returns. And this is a bit of a story. The taxpayer said he had trouble logging onto HMRC's self-assessment pages when he tried to file his 15/16 return. The tribunal did not consider this was a reasonable excuse. However, the judge expressed sympathy, but said as a director of his wholly owned company, the taxpayer should have been aware of his responsibilities to his personal returns and had left it late to resolve the issue. As to possible confusion between personal and company tax returns, a tribunal found from a transcript, and this is interesting, transcript of a call between the taxpayer and HMRC, that he'd been labouring under the misapprehension that filing his company tax return would also amount to filing his personal tax return. How many times have we heard that in the past day? This was a genuine belief, but it has also had to be reasonable. In this instance, the tribunal found that the confusion arose from what HMRC told the taxpayer in the call. He was anxious to comply with his obligations, but struggling to understand what he had to do. I could tongue-in-cheek say at this point, perhaps he should have paid his accountant something to at least try and help him. However, as the call took place well after the due date of the return, this could not amount to a reasonable excuse, and there was no reasonable excuse for 16/17. However, there were special circumstances. In this case, HMRC failed to consider the taxpayer's low income and the proportionality of the penalties. The tribunal said the taxpayer's income for the years in question was even lower than he recollected it to be. The judge went on, it's obviously reasonable for a taxing authorities to require a subject to make a return of their income, whether or not the income is low or high and whether or not tax is outstanding. But it's clearly possible for a penalty imposed for failure to make a return to be disproportionate when compared to the taxpayer's income. Fixed penalties were often justifiable, but it must be possible in extreme circumstances for a large fixed penalty to be plainly unfair to someone with little or no resources. The penalty for 15/16 would have amounted to very nearly 1/5 of the taxpayer's income. This was plainly unfair. He had tried to comply, so no tax was paid late, and HMRC was in part to blame for the late filing. Similarly, the penalty for 16/17 would have been 1/3 of his income. The taxpayer's behaviour had been careless but was not deliberate. The judge went on to say this was plainly unfair, and in conclusion for 15/16, the tribunal allowed the taxpayer's appeal against the daily penalty, the 6-month penalty, but not the additional £100 penalty, as this was not disproportionate. For 16/17, the tribunal allowed the appeal against the daily penalties on additional grounds of lack of proportionality, but not against the £100 and the £300 6-month penalty. The reason I've covered that is very simple. It is important that you do look at these penalties. Too often, and I'll be honest, within our office, when I'm not involved, I see these letters going out appealing against the penalties because the client wants us to. And we do, because the client is, it's reasonable to act on his instructions. However, the letter should not just be a letter, we appeal because. They should grill the client to ensure that you understand the reasoning behind these penalties, why they've been made, and hopefully have sufficient argument to demonstrate that either he had a reasonable excuse, or in this particular case, make the point in that appeal that if someone's income for the year is only £8,000, it's covered by personal allowances, but for whatever reason the return was required. If those penalties have ratcheted up to, if not hundreds, thousands, then you've got possibly a very good chance, as it with this case and other cases that have been over the last couple of years, as it being a disproportionate amount. So I'll leave that with you to consider. Now, another case, again to do with tax return submission. This is a guy called Mr. Rodriguez-Isa, ISSA. And he was made redundant in July 2016. And in his 16-17 tax return, which he sent in December 17, he omitted, and it's a strange omission, this, he omitted about £176,700 of income received from his former employer in the period December 16 to 17. I have to beg a belief a little bit that anybody would forget to put £176,700 on your tax return, but hey. And that was money he got after he left the firm. The return omitted any reference to his employer having written off a loan. HMRC said the omissions were unlikely to be accidental because the sums were significant. And as I've just sort of hinted, it does sort of beg a belief a little bit, doesn't it, that you would forget about such a sizable amount of money. Further, his settlement agreement, so the lawyers had produced a settlement agreement, provided that he was liable to income tax on the settlement sums, and he'd signed that document, which all lawyers expect, or employers, saying that he took legal advice before signing it. The taxpayer could have taken advice to ensure his return was accurate, but chose not to. In other words, he could have paid an accountant to look it over. The first tier tribunal noted the taxpayer conceded his return contained inaccuracies, but was not satisfied that HMRC had discharged the burden of proof that they were deliberate. So that was the key, because if it's deliberate, we have a significant higher level of penalties. The taxpayer believed initially that he'd completed his tax return correctly, but because he had used the figures provided on his P60 and P45, he did not understand the tax treatment of the loan waiver. I probably struggle to accept that, because if he'd signed an agreement at the time of departing, he'd either lied and just signed a document saying he took advice, or he had given advice. The tribunal said alleging that the taxpayer had deliberately filed inaccurate return is a serious matter. And I make this point too often to tax inspectors when they come reeling out from behind their barricade saying this was deliberate. Where such a serious allegation is made, it is incumbent on HMRC to put forward a cogent case and to challenge the appellant's account to the extent it is inconsistent with that case. That was simply not sufficiently done in the present appeal, and his appeal was allowed. So the point I'm trying to get over there, as I said a moment ago, too many tax inspectors will come charging out saying that was deliberate, not with a full structured explanation to be able to discuss it before the formal issuing of the penalty notice. I spend a lot of time currying favour with tax inspectors to ensure that when they get to the end of a case or end of an inquiry, that we've got a rapport in place, that we can discuss these things, or at least he puts in writing or she puts in writing before the penalty notices are issued, the logic of why they believe something is deliberate. That gives you, the advisor and or the client, the opportunity to say, nonsense, yeah, okay, I get that point, whatever, but at least to avoid the cost of having to go to a tribunal. And again, this is the problem where people too often either don't take advice and they end up attending the tribunal on their own. And to a degree, to be fair to this chap, he's achieved a good result in that the appeal was allowed, that the penalties were not deliberate. Sorry, the actions he carried out were not deliberate, with the resulting higher penalties. But it works equally, as I've just said a moment ago, in cases where you're handling them, that you should keep that dialogue alive. I've got a case this week where the letter I've received, it is clear that the relationship with the tax inspector and the accountant borders on adversarial. And I've been asked to look at it to see if I can pull something out of it. We all don't like tax inspectors, let's be honest. Well, most of them anyway. But if you do have an inquiry or there's an appeal on penalties or whatever, use the great words that I try to use, which is work collaboratively with them. It will, however much that might grate you to do it, by working with them, the results will be better. Yes, the cost may be greater, but you've got to explain to the client why you're working that way. Don't let him say to you, oh, you're on the taxman's side. We're not on the taxman's side. What we're trying to do is just achieve a result in a situation that might have been caused by the client or a misunderstanding by the revenue. Right, another case I want to just very, very quickly cover is a case that was back in May, but it's a case of the HMRC effectively versus Tooth. And this is a case where it demonstrates yet again where the revenue contends someone has done something deliberate, and how important it is to, when you submit a return, that you use the white box. People who've known me many years will know I preach and go on about this all the time. We as a practice try to ensure that when a tax return goes in, the detail is not just as prescribed in relevant boxes. If you've took a view and you believe that view is relevant, pertinent to how you dealt with something, or in effect the client has dealt with something because they're signing a return, you should not be afraid to put that information in the white box. So back in January 2009, the taxpayer filed his 0708 tax return using HMRC approved software. He'd taken part in a tax avoidance scheme and wanted to use the losses from the scheme to reduce his income tax liability. Due to a technical software issue with the form, the taxpayer was unable to enter the losses from the scheme as an employment-related loss. So he entered the loss on the partnership pages and explained in the adjacent white space that rather than a partnership loss, it was an employment-related loss. HMRC disagreed, and it issued a discovery assessment against the taxpayer, which he then appealed against. And the first tier tribunal allowed Mr. Tooth's appeal. The upper tribunal and the Court of Appeal dismissed HMRC's subsequent appeals. In the Supreme Court, Lords Briggs and Sales gave a joint judgment with which the other members of the court agreed. On the deliberate inaccuracy issue, the judges noted that the majority of the Court of Appeal held that it was enough if the deliberate inaccuracy could be found somewhere in the document interpreted on its own without regard to the rest of the document. The Supreme Court, however, disagreed, saying that there was no reason to depart from the usual approach to interpret a document as a whole. The fact that HMRC chose to use a computer to read online tax returns in the first instance did not alter the meaning of the document. In any event, HMRC invited the taxpayer to add information in the white spaces. Therefore, there was no inaccuracy in the document. Even if it had been, it was not deliberate because the taxpayer did his best with an intractable online form. As a result, HMRC's appeal failed. However, the judge went on to make some points about discovery. The first one was the court said there was no principle of collective knowledge. If an individual officer had already made a discovery that should be not regarded as a discovery once and for all by HMRC, to the effect that the other officers cannot make the same discovery in the future. Secondly, there was no concept of staleness. The idea that a discovery might lose its quality over time was contrary to the ordinary use of the language. The leading authorities and statutory scheme, was contrary to the ordinary use of the language and the leading authorities and with regard to a statutory time period. The question was, had the officer on deciding whether to make a discovery assessment subjectively made a discovery that there had been an under-assessment of tax? It was perfectly possible for someone to make a discovery, even if it was something already known to others. The first tier tribunal applied the law correctly. HMRC did make a qualifying discovery. Now, the case goes on a bit more, but the bottom line is here that when a tax return is received and the revenue are considering whether or not there's penalties or something similar appropriate, the whole tax return should be covered rather than just focusing on the box containing the incorrect entry when deciding if there was an inaccuracy. If there has been a deliberate inaccuracy which involves a taxpayer intending to mislead HMRC, then that has to be considered, and that if the tax return entry is correct, even though subsequently there is extra tax to pay, that doesn't necessarily create a deliberate inaccuracy. The third point is, and this is the point I think HMRC won, a discovery assessment cannot be stale, and the time limits for making discovery assessments are triggered only by reference to the tax years in question and the behaviour of the taxpayer, with no reference at all to the timing of the discovery. Where does that leave us? It leaves us that it's important that you complete the white boxes to minimise the likelihood of discovery, and that there is no sort of period of time where the taxman can come back.
Are you done, Bob? Great, thanks very much. Good to see you. Sorry I've not been very communicative this morning. I'm just
I think you've got your mic open, Andrew. So just bear that in mind. There is no staleness. Okay, right. Just a couple of very quick topical things before we come on to Rob. I don't know if any of you have had issues with your employer clients, where employees have found out that they claim the £6 a week working from home if they've had to work at home at any time in a tax year, particularly in last year and potentially this year. May I make a suggestion? We've sort of made our business clients aware of the availability of this. Surprisingly, maybe a number of them have chosen not to pay any fixed amount themselves to their employees, but as a result of what we made our clients aware of, they have sort of all led them to claiming via the HMRC website. So all I'm making here is a comment that it might be worth it where you've got clients who have got workers who've been working at home last year and this year. Firstly, for last year, they could make a claim. I think you'd probably do it via their personal tax account, probably would be the easiest, or maybe even something that maybe some of you use. And I've been using this when I've been helping people who are not clients, who are friends of my wife or children. I go into web chats with the revenue at night when there's rubbish on the telly, other than when England and Wales are playing. And if you can if you've got the person with you at the side, you can put their national insurance number in and everything. You can have a web chat and you can get your code altered just like that. So what I'm suggesting is you may want to make aware to your employer clients that if people have had to work at home and they've not paid the £6, they should be making these claims. Now, I am told for tax year 21-22, and what we now, how many weeks are we into that? We're into what, upwards of 9 weeks. I believe over 500,000 people have claimed online already for 21-22. So give that some thought. Right. Yeah, one final thing, I think, just before I pass over to Rob. Self-employed income support scheme. You'll appreciate that I think 3 payments fall in the first 3 payments fall in tax year 2021. Now, there is the only thought I've had on this, that might in certain cases spike the tax bills that people have. One thing to give some thought to, and I read a piece on this the other week, is that you could look at changing the accounting date to maybe spread, because I don't know, let me think aloud. If we've got a year end of April and the accounts for the year ending 30th of April 20, form the basis for 2021, with the 3 SCIS payments, that would certainly push up the taxable income for that year. Perhaps look at changing of the accounting date so that if the profits have dropped down during 2021, you might be able to spread some of the profit a little bit. Please tread careful when you do this. And I want to give another footnote of guidance here. Now, so from a practical point of view, there was a case about 2 years ago. I cannot remember the name of the actor, but he's the ginger guy in Harry Potter. And he had a case, and those of you who've attended the traditional tax clubs might remember me discussing this. And what we said at the time was that his accountant, he had a particularly good year, and his accountant changed his accounting date, but he'd done the statutory, well, not statutory, I think he was self-employed. He'd done his accounts into the usual accounting date. He then did a good number of other sets of accounts, presumably adding 1 month, 2 months, 3 months, whatever, to those accounts. And the revenue, when a full statement was made to the revenue, they said, well, which are the proper accounts? And they concluded that the original 12-month accounts were the proper accounts, and therefore the change of accounting date couldn't really be anything other than an attempt to mitigate tax. And that's the key point here. If you do change your annual accounting date by extending the period or whatever, it's got to be for a commercial reason. And trust me on this, trying to gain a tax advantage isn't seen as a commercial reason. So just bear that in mind. It's just a thought. Now, just reading something here, 2 queries which I'll quickly cover. Mr. Rainbow, would it be acceptable to include provisional expenses? Well, you're not setting any expenses against the SCS income. If you're talking of actual provisional expenses in the period by which you're extending, well, no, the accounting, your accounts, if you do them not properly, if you do the accounts on a timely basis, even if you're extending the year end, I would suggest you don't need to put provisional expenses in. If you're looking at this maybe 4 days before the tax return submission date, then maybe you could do that. But the likelihood, you'd have to put an estimate on it. And if you've extended an accounting period to try and minimize the impact of the SCIS, then with the estimated bit, those factors might just add up to having an inquiry. So be careful. Now, Phil, Is there any relief for excessive travel costs for a self-employed dentist who had to travel to work by taxi rather than using the public transport? Right. Well, the answer to that probably is no, because you wouldn't get a deduction anyway for the travel costs to work. Because if he lives, say, in, as an example, he lives in Crosby and has his dental practice in Southport, you won't get a deduction for that anyway. So the fact he's just having to swap for whatever reason his mode of transport from a motor car to a taxi, then I don't believe there would be a deduction there. Okay, right. Without further ado, I think we'll pass over to the legend that is Rob McCann. And over to you, sir.
Thanks, Alan. Thank you. Good afternoon, everyone. I haven't really got any sort of big ticket issues to talk about today, so I thought I would I'd give a bit of a run through of some of the sort of case law that's caught my eye in the last month or so, and also just one or two updates that have been issued by HMRC that might well be of relevance in terms of their sort of change of practice or change of view on one or two things. Now, the first two cases I'd like to discuss both relate to claims for overpaid VAT. Now, you'll probably all be aware that where a taxpayer has overpaid VAT on a VAT return or underclaimed VAT on expenditure on a VAT return, they have the option, they have the ability after the event to lodge a claim with HMRC to reclaim that VAT. But those claims are subject to a number of conditions. They have to be made in writing generally. They have to be fully quantified with the value broken down very clearly into sort of that period, and also the rationale for the claim. So the facts that support the claim must be made very clear in sort of that covering letter to HMRC. And also, most importantly, those claims are subject to a 4-year cap. So if we make a claim today, we can only include VAT that's been overpaid on VAT returns in the last 4 years. And it's that particular issue that's always subject to litigation. And is the main issue, I suppose, in the two cases that I'd like to talk about now. Now, the first case involved Royal County Down Golf Club. Now, there's been a long old battle, or there was a long battle in relation to the VAT treatment of green fees. It was always argued that green fees should be treated as exempt from VAT in the same way as charges to members for the use of a golf club are treated as exempt from VAT. And that was a long old battle that went on for many years. Now, off the back of that litigation, or certainly in the middle of that litigation, Royal County Down Golf Club submitted a claim for VAT that they overpaid, or they considered it overpaid, and that claim was made in March 2009 for VAT paid up to 2008. Now, that litigation was finally settled in December 2013 in favour of the golf clubs. So at that point in time, HMRC started to pay those claims out. Now, in early 2015, the court thought, hang on a minute, the club thought, hang on a minute, we've made this claim up to 2008 and that will be paid, but we've then got the period from 2009 to 2013 that we need to claim for. And they made a claim at that point in time. Now, HMRC rejected the first 2 years of the claim, of that update claim, on the basis that they were outside of the sort of usual 4-year cap. Now, in argument against that, the club said, well, no, we'd made a claim and we were simply extending or amending an original claim that was made in time, and therefore the claim should be allowed. Now, the court decided, I think, fairly certainly in my view, that in this case, this was a new claim. It wasn't an amendment to an existing claim, because it was based on VAT periods that fell clearly outside of the original claim, so it had to be a new claim, and therefore, as I say, those first 2 years were out of time. And even though it'd been acknowledged in the sort of ongoing litigation that VAT had been overpaid. They were entitled to a refund. Now, in a similar vein, there was a similar claim made by Leicester City Council that related to VAT that they considered had been overpaid on fees relating to the rental and use of sports and leisure facilities. Now, the claim was made in 2017 and related to the period from 06 to 2014. Now, at a later date, I think it was 2018, the council sought to amend the claims on the basis that although they were claiming for VAT on sports and leisure facilities or fees relating to those facilities, it excluded VAT that had been generated at council-run golf courses and also income from sports activities that had taken place in council parks. So the issue in that case was, once again, whether or not that claim was an amendment to the existing claim, bearing in mind that in this case we were looking at a claim for the exact same periods that were subject to the original claim, or whether it was a new claim and therefore predominantly out of time in light of the 4-year cap. Now, unfortunately, again, the court ruled against the taxpayer and ruled that this was a new claim. Although it might have been argued that the original claim related to VAT on sports and leisure facilities and therefore incorporated income from golf courses, etc. As to methodology used to calculate the original claims excluded turnover from those activities, the additional claim had to be seen as a new claim. So again, it was rejected outright. Now, I think those cases both serve as a reminder, really, that when we are preparing claims for overpaid VAT on behalf of clients, that we make sure that they're quantified properly, as I said before, on a quarter-by-quarter basis, that we include all relevant supplies in there. So if we're claiming in that example for sports facilities for the council, we make sure we include all sports facilities, even if part of that claim might be protective and maybe subject to discussion with HMRC. We want to make sure we throw the kitchen sink in there. And also, if there is a claim that's subject to ongoing discussion or negotiation with HMRC and might have been submitted originally on a protected basis, that we make sure that we continually update that claim to make sure that we're always, we aren't falling foul of the 4-year limit and losing periods of time but by submitting claims for certain periods late. And you know, that's, I think, quite an important reminder, because I'm continually speaking to accountants and clients that have missed the boat with regard to the updating of claims, and therefore have missed out on often significant VAT refunds. Another case that caught my eye, another judgment that caught my eye, was a case involving the Jupiter Asset Management Group. And it related to a common issue. It related to the VAT treatment of management charges. Obviously, in a group scenario, you've often got charges from parents of the subsidiary for the provision of management services. And VAT had been charged from those management services, so that in itself wasn't an issue. But one of the members of the group, or possibly more, weren't able to recover the VAT on the management charges. And in that situation where you've got services provided from A to B, and A to B are connected, and B is unable to reclaim the VAT on the supplies in question, HMRC has the power to calculate that with reference to the open market value if they consider that the supply has been undervalued. So the issue for the court here was whether or not the charge from the holding company to the subsidiary had been undervalued, and on what basis should open market value be calculated. And the court came up with a couple of principles that I thought were quite useful. One is, they said, firstly, you should try and calculate the open market value with reference to the value of a comparable transaction. So if you've got sort of supplies that you make to external businesses, and as well as group members, then you've got a clear comparator there. You've got the supplies that are made to the external the businesses outside of the group, and in that case, you would use that as the sort of barometer for determining whether or not the supply to the group member was at the market value. But often with management charges, that isn't the case. You haven't got a comparable transaction. And what the court said was, if that is the case, you've got to look at the full cost of carrying out the services. So that would include non-battable costs such as executive salaries, etc., or proportion of salaries, etc. But you don't need to necessarily consider any profit element, which I thought was quite interesting. So really, I think the takeaway there, I mean, not that we necessarily need to focus too much on open market value and what that means, but I think when, and this is no doubt a conversation that you'll often have with clients, is how to value management services. I think my view would be, as long as that charge is reasonable and isn't clearly undervalued, then HMRC are unlikely to give it any real attention anyway. And seek to argue that, or seek to even consider what the open market value. So I think as long as when you look at a charge, it sort of passes a reasonableness test, then that, in my mind, would generally be sufficient and would avoid any unwanted scrutiny from HMRC. Two other quick cases, one involving a business called Titanium Limited, and the issue, often you'll have an issue when you've got, and this cross-border transactions, when you've got cross-border transactions, particularly services, we'll often need to determine where the supplier and the customer, so the supplier and the recipient of that supplier, are established for VAT purposes. And it's an issue that crops up for me a lot, and no doubt a question that arises when you're looking at this type of scenario for your clients. Now, the appellant in this case, Titanium Limited, were a Jersey-based company that owned 2 commercial properties in Austria, but had no other presence in the country. They had no office, they had no staff, and a local agent managed the properties for them. And the quite simple question for the court, the European court in this case, was whether a property alone creates a fixed establishment for a business. And the court ruled quite clearly that it doesn't. In order for a fixed establishment to be created for VAT purposes, there needs to be both the human and technical resources in a country to create that establishment. So as well as having a building, there needs to be some local presence, human presence on the ground to facilitate transactions that are made in that country. And again, I think that's a fairly useful principle that has general application when we're considering where a supplier and recipient of a cross-border transaction are located. Final case is a very recent case, a case that was published this week, I think maybe last week, relating to a business that was partially exempt from a VAT perspective, the Royal Opera House Society down in London. Now, they generated 2 distinct income streams, really. They sold tickets to the opera, which were exempt from VAT due to the cultural VAT exemption, and they also generated catering income. So attendees at the opera had the option of paying for a meal either before or after the performance, and that income generated VAT. Now, this litigation has been going on for some time, and the question is whether or not the costs of production, the costs of producing the performance, are recoverable in part. The VAT on the cost of performance is recoverable in part, given that there is ultimately income generated that's both exempt and VATable. So the question for the court is whether there's a direct link between those costs and the catering income. There needs to be that direct link for some of the VAT to be recovered. And the court decided, and really this follows on, the court sort of backed up the view of the courts lower down the chain, that in this case it's sort of not enough to say that the catering income would not have been generated if the performance had taken place, the production costs are only sort of cost component of the performance, the ticket sales that were generated from the performance, and then therefore those costs were directly attributable to the exempt income of the society, and therefore none of the VAT was recoverable. And I think again that's quite an interesting might be the wrong word, quite a useful principle for us to use when we've got a partially exempt client and we're considering whether or not they're entitled to claim some or all of the VAT on a particular item of expenditure. Now, conscious that time is moving on.
Okay. Bearing in mind you told me earlier you didn't have a lot to talk about. I thought that was pretty good, actually.
Yeah, no,
and I didn't fall asleep.
Good. That's the start. I have got more to say if there is time, but only I don't know if not, it's fine. I can.
Well, I'll do
nothing particularly exciting.
If we can get rid of this Gregory chap reasonably quickly, you can have a bit more time. If not, tough. Right,
fine, absolutely fine. It's nothing particularly important, so it's no problem.
It's all right. No, we'll work it out. We've got plenty of time. Well, but I thought if we can just move on for now. Right. So Andrew, over to you. Shareholder agreements.
Thank you very much, Alan. And Rob, I'll try and be as quick as possible so that there is a bit of time left for you to come back. Well, first of all, afternoon, everybody. And just a very quick intro to me. So I am a director with Leonard Curtis Legal, which is a firm of solicitors. It's a firm that I set up 5 years ago. Alan, I think you and I last kept paths crossed when in my former life as a partner with a law firm called DWF, which is where I was for 25 years. Anyway, so I now head up the team at Leonard Curtis Legal, and we do a lot of work for the SME owner-manager client base. And that's really where I want to sort of start my discussion about shareholders agreements, because just Alan mentioned about my wife, who's now a retired solicitor, drafting his will. Lawyers always say, almost as a bit of a cliche, every client should always make a will. Well, I always say, and I know that a lot of accountants will say to their clients, if you're setting up a new company, you really should enter into a shareholders agreement. And actually, many clients don't, despite that advice, no doubt concerned about the costs, and also an element of why would we need such an agreement? We're all agreed on the way forward. We're either friends, family, business associates, or we're all sharing a common goal. Why would we need an agreement? There's even a suggestion that possibly we might not trust one another if we went to enter into such an agreement. What I would say to that is there are very, very sound reasons why a shareholders agreement should always be entered into by the directors of and shareholders of a new business entity that is going to be operating as a limited company. The reasons for that are very simple, because when you set up a company, and obviously you have a set of articles which govern the constitution of the company, but what those articles do not do, unless there is some legal work done to alter the standard form articles which Companies House will provide you with, or when you set up a new co, what those articles don't do is to give shareholders any, and that for that matter, directors, any real protection. And certainly there are very, very few rules and provisions in those articles which are actually going to enable the parties embarking upon this new venture to have a raft of protections and rules and regulations which govern the relationship in any kind of meaningful way. And that's why we lawyers say you should get a shareholders agreement in all cases. And the implications for not having one can be very, very serious indeed. We're acting at the moment on a number of disputes between shareholders where there is no shareholders agreement. it may well be that there would always have been a dispute between the parties. They'd fallen out. We've got one case, which is a husband and wife, successful business. They've got divorced. They're still operating together, the business, no shareholders agreement. The case is a nightmare, frankly. A shareholders agreement, if it had been in place, would have just made the position a lot more straightforward in terms of trying to unravel and resolve the different issues that now arise between the shareholders. So a shareholders agreement can't be a panacea for all ills, but it can certainly make life a lot more straightforward in terms of resolving these issues, and probably most importantly of all, reduce the very significant costs which can be involved in a dispute where there isn't a shareholders agreement. And just again, before we get to actually the kind of things that you'd find in a shareholders agreement and the reasons why, as I've said, that there should be a shareholders agreement, is because of the way in which the courts operate when there is no agreement. The courts over the years have described these kind of disputes between owner managers who are operating a relatively modest commercial concern. And by that, I'm talking about anything from a business turning over several hundred thousands of pounds to turning over anything between 10 and 20 million. The courts take the view that those kind of businesses are what's known as quasi-partnerships. What does that mean? Well, what it means is that although company law operates and has to operate, the courts recognise that effectively these businesses are run by people, by individuals, and they're run for profit, and they are, as a group of individuals, effectively, and inverted commas here, partners in the business. And therefore, the courts tend to treat the principles on regulating any dispute very similar to the way in which partnership law operates. And unfortunately, partnership law operates on the basis that if the parties are in dispute, then really everything has to be wound up and everything has to be sold. And so when clients come to me and say, right, I've got a dispute, I've got all kinds of problems with my co-shareholder, and the kind of issues that we see on a regular basis are the shareholders decided to set up a rival business, competing. Sometimes the shareholder and director's not working actively in the business, but still taking money out. We've had cases where, unfortunately, there's been serious allegations that one of the director has been taking money and stock and assets out of the business without obviously any agreement in an unlawful way. So in the absence of a shareholders agreement, what is the answer to all of these issues? Well, the answer is, from ourselves as lawyers, you have to go to the court and you have to issue what's known as a winding up petition on the just and equitable grounds. Now, winding up petition, I'm sure most of you will have heard of and know that it's primarily used by creditors who are owed money by companies and used as a device to put pressure on companies to pay their debts quickly. But this is a very different animal. This is a petition by the owners seeking the court's discretion to intervene in the dispute. And unfortunately, unless one party agrees along the way as part of the proceedings to buy the other out, then the court ultimately has little choice other than to make an order for the winding up. So this is a real kamikaze type remedy, because ultimately, clearly, that destroys value for all the parties in such circumstances, and really should be avoided at all costs. And I'm pleased to say that in terms of all the disputes I've ever dealt with in those cases, ultimately common sense has prevailed and value, or at least some level of value, has been preserved, so that the one party has ordinarily bought the other out and the company ultimately has not been wound up. But that's the ultimate sanction. And that's a dangerous position, because there are cases where one party is thinking, well, actually, quite suits me to have it wound up, actually, because then I can just go off and do whatever I like. I've got no constraints on me. There's nothing to stop me doing this. So these are important reasons why spending a bit of time with your lawyer in the very beginning when the new co is set up is very good, well worth doing. The costs involved in producing a shareholders agreement in the grand scheme of things are not enormous. I know that our profession gets a reputation for being expensive, possibly sometimes also unapproachable.
Only unjust.
Thank you, Alan. We at Leonard Curtis try to dispel that myth. And you know, a very, very small, very, very straightforward 50-50 shareholders agreement, we can knock out for about £1,000 from that. Something that's a bit more complicated with some more rights and obligations and some different provisions, because there's perhaps more than a couple of shareholders, or there's positions where there's a wish to issue different classes of shares to different shareholders, possibly to children of the founders, then that could cost a bit more, £1,500, £2,000 probably at most. But you know, in the grand scheme of things, and when you see the kind of costs which become involved in litigation to dispute to resolve these disputes, it is genuinely a drop in the ocean in terms of actually producing this. And as I always say to clients, the best situations and the best shareholders agreements are those that, having been completed, are put in the filing cabinet and no one ever gets them out and needs to blow the dust off them or deal with them ever again. And although that might be felt as, oh, well, that was waste of money, why did we need that? The fact of the matter is, sometimes the very fact that the parties set out at day one on an agreement about what the constitution between themselves as shareholders will be is a very important factor in all of this. So there is my explanation as to why there is a need for shareholders agreements. There's just one other important piece of law which I just want to explain to everybody before we go on to talk about the kind of things that you would ordinarily see in a shareholders agreement to regulate the position between the parties and to avoid, wherever possible, disputes at a later date, or if there are disputes, have a position where those disputes can be resolved in a relatively speedy and effective way. What's that piece of law? Well, quite often when we act in these situations, a director and shareholder will come talk to us, and perhaps, you know, it's often the situation where the other director, they're not pulling their weight, they're diverting business away. They've decided they don't like their co-shareholder. They decided that they'd like to go off and do something else. They start diverting customers and the like. Money starts going missing, or business or sales start falling. All sorts of issues. And certainly from a moral point of view, you can see why perhaps our client in the situation where they're seeking advice because of the conduct of their co-director and shareholder actually feels they're in the right, and the law therefore will be on their side, and the law surely must be there to protect them and enable them to take action. Well, in the absence of a shareholders agreement, unless I've said the parties or our client in this case was prepared to go down the draconian route of a winding up petition, then actually the ability of our client director in those circumstances to do something to resolve the issue very limited. Why is that? Because a lot of the issues that we see are issues which are actually matters which the company should be pursuing. So if there's business being lost by the company, if assets are being moved out, then obviously it's the property of the company. It's the company's concern, and it's for the company to bring those legal claims. However, how does as it were, the wronged party, our client in my example, actually take action? What powers does that director have to cause the company to pursue the other party? Answer, none. The remedy in such circumstances is to apply to the court for what's known as a derivative action, whereby the court gives the director the permission to effectively control the company and have the company sue the other party. Very expensive. We ran an application for a derivative action to the courts last December, the costs on each side were about 17,500, including our fees and counsel's fees for a full day hearing before a chancery judge in Manchester High Court. These are not proceedings for the faint-hearted. Those proceedings could have been avoided if there had been a shareholders agreement in place. So let me tell you a little bit then about the kind of things that you would ordinarily expect to find in a shareholders agreement. These agreements, they run on average perhaps to 8 to 10 pages. They're not actually the most complex legal documents in the world. They are relatively straightforward and tend to be pragmatic and sensible documents. You can get some very, very highfalutin, very, very complex versions of these agreements. We don't subscribe to them at Leonard Curtis Legal. We don't think that's the right way. We think you're better keeping it straightforward and clear so that everyone understands what they're signing up to in those circumstances. So the kind of things that you would ordinarily expect to see, first and foremost, is firstly, a brief description of what the business does so that it's defined and everyone's clear as to actually what is the nature of the business. That's important because if at a later date there is some disagreement about what are the core markets for the business, then that can be nailed day one. It's there in black and white. If we get a situation where a director or shareholder has decided to start going off and doing their own thing, a common occurrence in our experience, then that can be pinned down as a area of competition, and there can then be provisions in the shareholders agreement, as you would ordinarily expect, for non-competition. And the reason that's important is because not only does it define then the obligations of the directors, which would ordinarily you'd expect that for that it means that they work full-time and in the best interests of the company. But if one of those directors then actually breaches those provisions, then not only the company through its rights to apply to the court, but the other shareholder can then enforce those rights because they've got a contractual right, which is where the shareholders agreement makes a big difference. Because if there's been no shareholders agreement, you're reliant upon the company's articles. As I've said previously, the articles won't give you sufficient support. So you need that contractual ability to sue the other party, or at least to threaten to sue them if they don't behave themselves and get back in line in terms of their conduct. So that's a good example of an important provision in the shareholders agreement. There are also some other much more less controversial reasons why you would want an agreement. What happens if one of the shareholders becomes seriously ill? What are the arrangements there? Do they continue to get paid? Do they continue to get dividends? Well, the answer would be absolutely yes, unless there's some contrary provisions in a shareholders agreement. Likewise, God forbid, what happens if one of the shareholders dies? Well, answer is shares that go to the estate. Does the other party really want that shareholder's family getting involved in the conduct of the business? Of course not. So again, there should be provision in the shareholders agreement that provides what happens to the shares on death. Again, there are no specific provisions in the article, in the standard set of articles, that would deal properly and adequately with that situation. What about the actual running of the company day to day and its finances? Again, this is a bit of a cliche, but I've said this often to clients. There is nothing to stop your co-director going out tomorrow and buying themselves a Porsche on the company or some other expensive item. How could that possibly be the case? Says the director. This is my client director, because ultimately the powers under the Companies Act given to directors give them that right to do so. And in the absence of a shareholders agreement, they can do effectively what they like in the terms of that. Now, again, there may well be some arguments that they're in breach of their duties to the company by doing that. but there's nothing that a shareholder or director can do legally to stop them doing that. But some provisions in a shareholders agreement that control the powers of the directors as to how much they can spend, what they can do, regulating their conduct, in a clear way, can work very well. Often, clients propose that if they're going to go down that route, they will also have service agreements as well as a shareholders agreement. So it's clear as well in terms of what their employment obligations are. And that's always a good idea. If clients want to, as it were, do a belt and braces, where they want to spend a bit more money, then get a contract, get a service contract of employment which works with the shareholders agreement. So, but they're for working hand in glove together as a set of legal agreements. So that's control on finances. What happens if ultimately the parties then decide they're going to go their separate ways? They've fallen out. Again, there'll be nothing under the standard articles that provide as to how the shares will be valued, what happens about any dispute over valuation. If one party doesn't like a valuation, what can they do about it? Again, a well-drafted shareholders agreement will provide provisions which cover off those kind of situations, so that at least if the parties are going their separate ways, everybody knows what the provisions are, what the money will, how any money will be agreed and paid. I've got a call later on this afternoon with a client who's an IFA who's got a dispute with his co-shareholder. We've got some real issues about how we're going to get to a valuation on the shares. Our client will probably buy the other guy out, but we're quite a way off yet in resolving just how those issues are going to be managed. And again, no shareholders agreement. And I hasten to add, this was not a client we'd acted for previously. We got involved once the dispute became apparent between the shareholders from that. So, I mean, I think I've covered off a lot. I mean, there's obviously many other provisions which could be tailored to the particular circumstance of a business that can go into a shareholders agreement. It's important that the solicitor acting properly understands the business and properly understands the dynamics of the parties. But I'm conscious of time, and there's probably enough in that, Alan, just to give people at least a glimmer as to just what the issues are with shareholders agreements. I've got lots and lots of examples of case studies that I could share with you about cases where things have gone very badly wrong, but I'll perhaps leave those for another day and hand back to you.
Thank you very much, Andrew. All I would say is because I've been on the planet a few years, I see these disputes happening more often than they should. You're absolutely right. When the new co first gets formed, the best mates from school have formed a business, they're dead happy, and then you get to the age of 45 and you find that both each think each other's a plonker, you don't like what they're doing, and then when you try to carve the business up or whatever, there's all this horrendous legal process that some people, a bit like divorce, maybe they wish sometimes he didn't even start it, but hey, that's where we are.
Yeah.
Right. Okay. So a couple of more things and then we'll pass back to Rob. Can I just answer something that Phil said? He said when we were talking about the dentist before, apparently the extra costs were due to COVID and keeping isolated. I'm not aware of any specific concession as we speak of that. Someone who can't get to work by his normal travel has to take a taxi would get treated differently. The only case I can cite at this point is that if you go back and think about the Dr. Samidian case, travel effectively from home to your place of business is not an allowable cost. Whether or not there's a groundswell on this sometime next year when people are doing tax returns for 2021 or 21-22, I don't know, but the basic rule is that travel to your place of operation, if you're self-employed, is not regarded as business travel. And the other case that I can support with that is the chap who ran the burger bar, who had his lockup about 2.5, 3 miles from where I'm actually sitting at this point. And he argued his lockup was his place of business. And he travelled at least 3 times a week to various markets in Cheshire. And I think he was at one location, maybe 2-3 days a week. And the revenue said, that's the place of business, not the place from where you set out. It's where you actually conduct your work. So for 3 days a week, you've got a permanent sort of work area. The other 2, yeah, we might accept that from when you set out from your lockup to them that they're allowable. So in answer to that, Phil, I think the answer is you won't get relief. Right, a couple of things I just wanted to cover, and then we'll touch base with Rob to finish off on his bits and bats. I think I may have mentioned this, and if I have, I apologise previously, but I don't know if you're aware, with effect from the 4th of April 22, where you have a business, where you have a business that has to renew a license to trade with the local council or whoever, one of the checks that they will make on whether or not to renew your license is, are you registered with HMRC to pay tax? Equally, at the point when you apply on the first occasion, that I am led to believe they will have to sign a document saying they are aware of their need to seek HMRC guidance on submitting an application to be registered for self-employed. I can't prove this, but it does make me wonder if after the 4th of April 22, copies of those documents may even be sent to HMRC, so HMRC can make sure those people are registered at the due time. So just bear that in mind. It's principally, I don't know, taxis, private hire, scrap metal dealers, and maybe those great people, mobile collectors of scrap. Right. Carryback of losses for companies. I hope you're all aware that it was announced in the budget that provisions are going to be put in place for companies to make claims to carry back losses for a further 2 years, and current rules allow. This temporary extension applies for losses arising in accounting periods ending between the 1st of April 20 and 31st of March 22. The one point I want to make clear though here, no claims will be processed or even accepted before the finance bill gets royal assent. Now, the royal assent normally from memory is around about mid-July, and the revenue have gone on to say that any claims received before royal assent will not be processed, and it's likely claimant companies will be asked to resubmit their claims in July. So if I was a betting man, perhaps if you've got any accounts where you believe the loss relief will be available in the new extended form, perhaps leave it till the 15th, 16th of July before submitting the appropriate claim. Time to pay payments. Just want to remind you, the revenue did publicise quite heavily that the people who, or the businesses, sorry, who deferred VAT back in March 20 or around about there, should be getting in place a time to pay to clear those arrears. You can do it online. I think they say the last occasion you can do it is in July, and you would then get in place an arrangement for 6 or 7 months at the end of the calendar year. If you need longer, or sorry, if your client needs longer to pay, then they should approach the HMRC time to pay debt management helpline. Those of you who are in the know, there is an agent helpline. I use it at least once a week. It can take anything from 10 minutes to 40 minutes to get through, but generally, provided you can get through the security and you can find a 64.8 on the system, they will speak to you. They will listen to you. They will probably even agree the deal, if indeed a deal is what you're after, but they probably won't agree to put that in place until they speak to the client, or certainly a company officer who has power over the bank account. So it's always good to have on standby the financial director, the financial controller, the MD, the owner, whoever, not necessarily to partake in the whole of the call, but certainly either to call back after or come into the call at the end. But there are some good deals to be had out there, and they won't be around for much longer. Right, next point, again, just before I come on to Rob. Right, if we were sitting in a room now, I would be saying to you, put your hands up if you've ever submitted a tax return where the client is hopeless, but you feel you should still look after him, and you've submitted an estimated tax return and perished the thought it wasn't signed. And the silence I have is the obvious one, but equally, if I was in a room, I suspect there'd be silence as well, because nobody will ever admit to that. Am I correct? So this is a case not that long ago, like in February when it was published. And the issue was whether tax returns not signed proved that the taxpayer had not been involved in their preparation. Now, I know a firm of accountants who, I'll put my life in it, aren't in attendance today. And I know that they probably submit a couple every year with estimated figures on, because they say things like, Alan, they're hopeless. I said, well, if they're hopeless, just write to them and disengage. Well, I don't want to do that. And he gets himself, this guy, in a mess every other year because the revenue pick up on it. And they say, oh, so, it might be through a letter or through a meeting or whatever. And you say to the client, oh, did you approve that estimated return? And we have this silence that is incredible. So the taxpayer, Mr. B, was a self-employed subcontractor who engaged Practice K as his agent. HMRC raised discovery assessments and penalties in respect to the years 11-12 to 13-14 and 15-16. The taxpayer appealed. He said that he had acted responsibly and his agent had disappeared without leaving him or HMRC any documentation. There you go. The first tier tribunal said that the taxpayer's behaviour was careless. He did not check the returns nor the expenditure claimed. That'd be a novelty for some of our clients, wouldn't it? There was no evidence of the documents that he gave to his agent, and it was not clear how the returns were filed without the taxpayer having signed them. The tribunal said the agent had also acted carelessly by not providing the return to the taxpayer to check. Now, there's no reference to which firm this was, if indeed you would ever publish that. Anyway, you'll be gobsmacked to hear the taxpayer's appeal was dismissed. Now, with that, Rob, do you want to come back to life? Would you like to finish off in a flurry of knowledge?
I can do, although I feel I've probably slightly overplayed my hand and this probably isn't as exciting as maybe you've made it sound. But yeah, just
no, nothing in VAT is exciting. We've agreed on that a long time ago.
Very true. Just one or 2 points that I want to raise in terms of HMRC's, say, view that's been published. I think probably quite important for us to be aware of. One relates to VAT recovery on the cost of electricity for charging electric vehicles. Now, HMRC have said that where a sole proprietor charges a vehicle at home, they're able to recover that on the electricity cost to the extent that the vehicle is used for business purposes. So the client will need to carry out some sort of apportionment, maybe keep a record of business net miles, private miles, etc. Now, if an employee of a business charges a vehicle at home, then none of that VAT is recoverable on the electricity cost, given that that's even if the vehicle is used for the purposes of the business, given that the cost has been incurred by the employee and not by the business itself. And then finally, if an electric vehicle is charged at an employee's premises, then again, the VAT can be recovered, but only to the extent that the vehicle is used for business purposes. So again, an apportionment will be required and possibly a record kept of business miles and private miles. Now, the only other relevant HMRC communication, well, the only one that has general relevance, I suppose, is you'll probably be aware of the rules that relate to new build housing and the fact that construction services and construction services and the sale of a new house generally are subject to VAT at the 0 rate. So there's no VAT to pay. With a number of exceptions, white goods, that's normally paid on white goods, carpets, and certain other items that fall outside of HMRC's definition of building materials. And historically, manual blinds have fallen into that same category. So developers haven't been able to reclaim the VAT back on blinds. Homeowners, maybe do-it-yourself house builders haven't been able to claim back the VAT on blinds. And finally, after much lobbying, HMRC have changed their position on that now. And now it is possible for that to be claimed by developers on and DIY house builders on the costs of buying those blinds. So again, if we've got any developer clients or clients that are involved in the construction of new build housing, there may be an opportunity there to recover that VAT or make a claim to recover that VAT. So that is probably that, Alan, from me, just a couple of minutes. So I'll pass back to you and thank everyone for listening to me.
Thanks very much, Rob. As always, thanks. Right, one final piece of recent case law. This involves the nugget that we have all the time: is someone employed or self-employed? The taxpayer, who worked as a negotiator, appealed against a determination from HMRC that he was self-employed between May 20 and May 2013. So we've got the strange situation here, maybe strange in my world anyway, of someone where the revenue is determined he's self-employed and he said, no, I'm not. So there was no written contract between the taxpayer and the company. The company was an insurance broker. And although there were some unsigned contracts for services in employment, he worked mainly from home, the Lloyd's building in London, or at the offices of the insurers with whom he was negotiating. He had no desk at the office of the companies that engaged him, nor was he given a staff handbook. It did, however, provide a laptop, a printer, a business card describing him as sales director, and a company credit card. He had no professional indemnity insurance of his own. The first tier tribunal considered that none of the communications between the taxpayer and the company suggested there was a mutual intention that the company would employ him. It may have been contemplated early in the process, but thereafter the terms proposed by the insurer, the company, were consistent with self-employment. The taxpayer could not establish that the company paid him salary. The tribunal concluded he was paid on the basis of commissions. Furthermore, the taxpayer was responsible for his own diary. He did not appear to be precluded from working for any other companies. The insurer did not direct him on how to do his work, and any reporting was irregular. In addition, the company did not enroll the taxpayer in the pension scheme or pay him holiday pay. The tribunal agreed with HMRC that the taxpayer was self-employed and therefore the taxpayer's appeal was dismissed. I'm going to keep a copy of this case. This is G. Phillips. The only time people argue that they're an employee is when they've not paid their taxes. Because if they've paid the taxes and they like the idea of being self-employed, it never comes up as a dispute. But when someone is a bit lax in dealing with their tax, and they might go to a clever accountant who, when he's doing your tax returns, can say something like, actually, you know, you could be an employee, and if you are, the arrears will be paid, or the tax due should be paid by that company. And I suspect we've not got the full story. This guy's obviously intelligent. He's got an interesting job, but he didn't either have the funds or didn't want to pay the funds to HMRC. When you read it through what I've just said, probably on the balance, he was self-employed. And if I would hope most of you would agree that if the revenue came along to try and argue that he was an employee, for whatever reason, maybe your client is the taxpayer who's got his affairs under appeal, you would hope that the revenue would see it that way. But I'll put a pound to a penny on it. If they were looking to challenge the other way, a lot of what's been said here, they would not conveniently use. So it's a case worth keeping in your mind. It's G. Phillips and the number is TC 8074. So please just keep a note of that one. It may be useful to you in the future. And with that, dead on 2 o'clock, which is an achievement on my part, I'd like to say a big thank you as always to Rob. And it's been a pleasure having you here, Andrew. If anybody wants to chat to Andrew, I suspect, have we, Ella, is Ella there? Has Ella provided your phone number? I'll tell you what, anybody who wants to speak to Andrew, if you email me after, I'll make sure his mobile number's passed on. Is that all right, Andrew? Brilliant. Okay. Well, with that, we'll say bye-bye. We're in June, near the end. We could be even out of lockdown shortly, properly. The next one will probably be in September, probably online, but who knows, by then we might even be getting back to normality and you can see my ugly mug face to face. All right now, all the best. Bye-bye.